Kangaroo Studios, the AusBiz COB is the key stuff you need to know about the day in business and finance.
Hello, welcome to the COB this Friday, the 7th of February. I'm Juliette Sarli. Let's have a quick look at where the local market is finishing the week's trade on the first week of reporting season. Pretty flat there on the SIBO 200, very much a seesaw session more broadly, swinging between gains and losses. We're awaiting the US jobs data out of the US. We've also seen coal miners very much hit hard, as we heard that CATL has reportedly reopened its China mine, also affecting a lot of the lithium players, and energy stocks falling as well following yet another volatile session for oil prices. So let's have a look at the themes of the day. As we mentioned, a seesaw session as we kind of move between positive and negative territory on the last trading day of the week. We've also got dough rising there. Domino's coming through with announcement that it is going to close a lot of its underperforming stores, particularly in Japan and France. Not sure at what point you would think that a sushi nation, loving nation rather, and a country where they have all those beautiful baked goods would be really into Domino's. Nevertheless, they do seem to be closing a lot of those stores, and shares rising the most in a decade, giving Domino's a market cap of some $3.3 billion. And then we've got the dependables there as well. I had a really interesting chat earlier today with Sandstone Insights, John Lockton. You can find it at ausbiz.com.au. He said so far there's been some really blockbuster results coming through from reporting season at very early days, and he said it was some of these dependables, the likes of REA Group, which reported yesterday, and also Nick Scali, the furniture retailer, which came through with numbers today. Let's have a quick look at some of the sector movements, and we mentioned some weakness in energy players today. Beach Energy in particular down 5.5%. Having a look at the tech players though, because there was some positivity coming through there. NextDC reporting in about a week or so, I think. It was up 2%. WiseTech Global also had a good day. Zero lower though. And remember, Amazon shares fell in after hours trade, with investors disappointed by its earnings guidance. And having a look at the banks, Commonwealth Bank yet again continuing to trade at or near records, up a third of 1%, $162.78. It is out with its numbers next week, and we'll be speaking with CEO Matt Common. Let's have a look at some of the corporate stories. With Domino's, we mentioned to close 205 loss-making stores, including 172 in Japan, and I think that's something like 1 in every 5 of the 944 stores they have in Japan. Shares up 22%. Sigma Health also had a great day today, upgrading its full-year earnings guidance due to the costs, of course, as well, saying that it will be significantly impacted by non-recurring costs relating to the merger with Chemist Warehouse. Neuron Pharmaceuticals said it will meet with US FDA officials to discuss the third phase of its clinical trial for its treatment of the rare genetic condition Phelan-McDermid syndrome. Nick Scali, we mentioned coming through. It was one of the dependables that John Stockton mentioned, and it declared a fully franked interim dividend of 30 cents per share. Shares rising 12% after its numbers. And Charter Hall Longwell REIT also reporting an impressive jump in first half profit. Shares higher by a third of 1%. Let's get to our Friday guest now, and welcome to the COB, Shane Oliver from AMP. Shane, great to chat to you. I was reading yours and Deanna's note as well on the tariff implications to Australia. We know at this stage not likely to hit our economy too much, but how are you sort of reading all the headlines coming through from the White House?
Well, I guess that old saying, you take Donald Trump seriously, but not literally. And that is the case with all of these headlines. We are getting bombarded with headlines. Some will come to something, some will not. It does appear that those tariffs are partly aimed at negotiation, but they're also partly aimed at redressing trade deficits and raising revenue. And the trick is trying to work out which mix of those two or those things will dominate. It looks to me like I suspect that the tariffs on Canada and Mexico will be substantially scaled down or may not go into effect at all in return for more heavily policing the border and stopping drug flows and so on. A bit more uncertainty around China, though. I think there is going to be a meeting between Xi Jinping and President Trump, or at least I hope there will be. And China's retaliation so far has left a lot of room for negotiation. They're their retaliation was very, very mild. But by the same token, the US does have many more issues with China than it does with Canada and Mexico. So a long way to go on this. It does remind me a bit of 2018. The tariffs back then were first announced in February of 2018. And then, of course, each time that announcements occurred, there was some sort of dip in markets. Markets would then recover. We get all the way out to September. And then it became too much combined with the Fed hikes. And shares had a fairly decent correction through September, December. So maybe you could see some sort of workout like that. This time around, I suspect it's going to occur a little bit earlier, though. The volatility comes a little bit earlier. But the good news is that, the US administration does seem to be taking seriously the need to keep long-term borrowing costs down. Those comments from Scott Bessant, the Treasury Secretary, were very positive. We are seeing still good news on inflation globally. Central banks like the BOE still cutting rates. So overall, it's still a reasonable environment for shares, just going to be a bit more volatile and more constrained than it was last year.
Yeah, I was looking at your outlook. So more volatile, more constrained, but still you're looking at some sort of growth of something like 7%. Is that right?
That's right. Still reasonably good returns, just not as good as they have been. We had 2 years globally of back-to-back 20% plus returns from global equities. That's unlikely to be repeated. It's possible. Momentum is still favourable for shares, so it's always possible. But I think you'd have to say the risk is we go through a more constrained environment. So that's why we penciled in those far more modest returns.
All right, let's talk about the overall broad economy then, because we are not really getting any market moving data ahead of the RBA decision, but we did see a little pickup in household spending this week. It's pretty light on when you look at the data for next week, but is there anything in your view that's going to change the needle when it comes to what the RBA will think ahead of its next meeting?
Well, that's the thing. We've got some numbers next week on consumer and business confidence from Westpac and NAB. They come out on Tuesday. Overall, though, it's a pretty quiet week. There's a new quarterly housing finance numbers come out on Wednesday, but I don't think they will move the dial in any direction. I think most of the important data is already out there. The next round of jobs numbers are not until after the next RBA meeting in just over a week's time. So in my mind, it comes down to, are they getting what they want on inflation? The answer is yes, perhaps more so than they were expecting. That then sort of brings into play the comments they made back in late December in their minutes, which indicate that if they're getting what they want on inflation or more, then they might be in a position to start cutting interest rates. So that's why I lean to the view they'll cut. But obviously, a lot of economists point out the uncertainty out there regarding tariffs. I tend to think and agree with the market that if you look at what happened this week, the probability of a cut started the week up at 93%, then went up to 96, 97%. I tend to think the tariff war increases the probability of a cut, not decreases it, because it's more of a threat to growth than it is to inflation. So all up, we lean to the view they'll cut, but nothing's guaranteed. I don't think the probability is quite as high as the market is saying at 96%, probably a little bit lower than that. But by the same token, I think if they are going to do it, now is a good time, and then it'll be a long, slow process, and they'll probably have a pause at the April meeting.
So what does all that mean then potentially for what we see in the housing market? Because the core logic data out this week was showing, not much happened in terms of price growth in January.
It was pretty dull. Nationally, it was flat. Capital city prices were down 0.2%, but big divergence there with 3 cities seeing falls and other cities seeing rises, the same ones, Adelaide, Brisbane, Perth. So that divergence continues. But the basic picture is the property market has cooled down. I suspect that all this talk about lower interest rates may be starting to invigorate it again. The clearance rate numbers that came out last Saturday were a little bit on the stronger side, although only back to average levels. So it looks to me like the property market here is at or close to bottoming, but time will tell on that one. A lot hinges on what happens with the RBA. If they cut in February, then I think we'll see a bit of flatlining for a while, maybe a little bit more downside, but then gains through the second half. If alternatively they wait till May, then those gains may take a little bit longer to show up, and we could see more downside in prices.
All right, Shane, of course, the key focus now for markets, we're always forward looking, the jobs data tonight. What are you expecting? How's this going to move the needle?
Well, it looks to me, I don't have a different view to consensus. Consensus, I think, is for 170,000 new jobs, 4.1% unemployment, which would be unchanged, and wages growth ticking down, I think, a little bit to 3.8%. If that's the case, then I don't think it has a big impact on things. But either side of that, it could have a big impact. Obviously, the Fed in the US would be a little bit nervous about the tariffs and what they may mean for US inflation. And we do get some data on that in the next week out of the US. But you can see there on that chart there that if they do even a fraction of what's been talked about, you're actually getting quite a big rise in average tariffs going into the US. That chart goes back to 1900. If Trump does all that he's talked about, we go back to around 20%, which is back to where we were in the 1930s. Not a good outcome. But even if it's a much smaller proportion, you're still going to get a bigger impact potentially than what we had back in 2018. And the Fed would be worried about the inflationary consequences of that. But anyway, in the next week, we do get those inflation numbers, I think out next Wednesday from memory. And they'll probably see inflation in the US sort of going sideways, 2.9% for the headline, 3.2% for the underlying, which probably won't change the Fed's thoughts on things. I think they're going to leave, or it almost looks like they're going to leave rates on hold in March. And then wait for the next meeting, which is another 6 weeks later. So maybe a while before we get another Fed cut.
Indeed. All right, we wait and see. As always, Shane Oliver, thank you as always for your insights. And of course, we'll catch you next week. Shane Oliver, AMP Chief Economist. All right, back to the equity market. The stock of the day was Domino's Pizza. June Bailey from 10Cap and Adam Dawes from Shaw and Partners joined the Dean.
What this means is that they are rebasing the expectations now. They are cutting the loss-making stores, which means that the overall, per store profitability will increase, and which means they will meet their expectations and market expectations. At the same time, by reducing the amount of unprofitable stores, it gives them a lower base so they can grow from here in the following few years.
But they are expecting to get synergies of around 10 to 12 million. But there will be a one-off incurment for those restructuring costs of 61 million as well. So it's certainly going to do well. And I think the market's going to look at this a little bit differently now. And with that short squeeze, hopefully that overhang has now somewhat subsided.
Okay. All right, let's have a quick look at the market leaders on a day where we mentioned we sort of seesawed into the close. Domino's, they're having a fabulous session. Investors seem very impressed by the turnaround plans by the new CEO, who's only been in the job for 3 months, certainly moving to close a lot of those underperforming stores in France and Japan. Collins Foods kind of rallied on the back of that. Remember, that's the KFC and Taco Bell owner. It also had a broker upgrade from Macquarie today. Liner Sigma Health, we mentioned there, of course, coming through with an update, particularly in relation to its Chemist Warehouse merger. To the downside today, we didn't hear from, but we saw weakness in Chalice Mining, Strike Energy, Beach Energy. That was the weakness we're talking about in the energy space. And of course, we started to see quite a lot of weakness coming through in these lithium players as CATL reportedly reopens its China mine. Liontown Resources down 5%. In the small end of town, Brockman Mining had a very solid session, as did AI Media Tech, which was heavily sold off earlier in the week, so it was up 18%. Delta Lithium really bucking the downward trend across some of those other lithium players, and Restaurant Brands New Zealand up 10% on the back of the moves that you saw in Domino's and also Collins Foods. Having a look at the laggards in the small end of town, these are some of the losers. Findi was through with an update a couple of days ago, I think, about expansion with its India plans in terms of more ATMs there, but a weakness today in High Pages as well, down by 8.2%. Of course, tonight it is all about the jobs data in the US. We also get consumer credit and consumer sentiment figures out in the US. And when we look ahead to next week, a fair bit on. We've got US one-year consumer inflation expectations. We've got US CPI, PPI. Also, of course, some household spending data coming through from the CBA next week, and Westpac's monthly consumer sentiment survey as well. And when it comes to earnings, of course, very, very big one next week. We've got CBA, we've got AGL, IAG, Cochlear. We're going to speak to all those executives, so keep it on AusBiz. We've also got a raft of other companies coming through, so it's going to be one of the busiest weeks, as it so often is in reporting season. The local market finishing fairly flat there on the CBO 200. The ASX 200 actually closing lower by 9 points, 1/10%, 8,511. And over the course of the week, the ASX 200 I believe is virtually unchanged and just about 7/10 below its all-time high. Energy, utility, healthcare stocks certainly weighing us lower today, but we saw a pickup in REITs, in consumer staples on the back of that Domino's rally, and in tech players as well. All right, as I mentioned, it's going to be incredibly busy next week with reporting season. We do have a lot of executives talking to us, so please do keep it with us. We'll be back live from 9:45 a.m. Eastern. Have a safe and great weekend.